Welcome to 15-Minute Fundamentals, where we break down crypto projects and learn about the drivers behind the data you see on our charts. Today, I'm joined by Quag from NFTX, a liquidity protocol for NFTs. Hey Quag, welcome to 15-Minute Fundamentals. It's great to have you on.
Great to be here.
To kick things off, could you give a quick intro to NFTX?
Yeah, so NFTX is a liquidity protocol for NFTs, and I guess most notably, it's like fully permissionless. So everything happens on chain. It's not like an OpenSea marketplace where it's all handled on databases with signatures. It's a fully on-chain liquidity protocol for NFTs.
How does that work in practice? So at a bit more of a technical level, what is a liquidity protocol for NFTs?
So I guess the main underlying tech behind it is you have an NFT, so an ERC 721 or 1155, which traditionally isn't fungible. And you would deposit that into one of the NFTX vaults, and in return for that, the vault would take your NFT and then hold it in the vault, and it would return you one ERC20 token that sort of represents that NFT in the vault. So like one of the key concepts of NFTX is to like vaults to NFTs, there's always like a one-to-one mapping of like the ERC20 token. So we'll say Punk, for example. If you put a Punk into the vault mints one Punk token, and then you get back one Punk token. Now, if you're selling there and buying, there are fees attached to that, and the fees are paid in the Punk token. But that's ultimately how it works. You deposit a NFT into the vault mints a token and gives that out. And to then take an NFT back out of the vault, the contract requires one Punk token to go in, at which point it will then burn that token and send a Punk back out.
Yeah, so it's a very different model to what users might be used to seeing with peer-to-peer marketplaces like OpenSea and LooksRare. And on that, it would actually be really interesting to hear what the main innovations are from a user perspective that you introduced with your model compared to these other solutions.
So this was sort of the first real attempt, I believe, at sort of turning a non-fungible token to something fungible. And at the start, it was just quite a crude interface where people could LP and sort of just earn regular like Sushi AMM or Uni AMM fees on these pools. It was quite a big step forward, I think, in the tech at that time. Sort of unlocked a lot of potential for people who wanted to be able to sort of buy and sell or start running arbitrage on stuff if they could realize they could buy on OpenSea and then mint it into NFTX and then sell that token into Sushi. I think people were quite profitable in those early days. I think the whole NFTX model and the idea of instant liquidity of NFT floors kind of kickstarted the whole like MetaFi scene, really, with like the financialization of NFTs when people realized that there was sort of this liquid floor available. I think really sort of helped boost the idea of quote unquote floor that everyone talks about now, what is basically the best bid on the table, and that came from like these sushi pools that were just representing the liquidity. So it wasn't like a person, having to buy. This was literally just a permissionless, always there liquidity pool. And if there's always a buyer of last resort, and it was always the liquidity pool.
Exactly. And instant liquidity at a floor price of an NFT is a pretty valuable feature. Can you actually explain how these floor prices are determined on NFTX?
Prices is fully determined by effectively the market or the liquidity pools. Since the NFTs are minted into ERC20 tokens, the whole NFTX pool is basically just backed by a liquidity pool of ETH and however many of the tokens, and so like Punk and ETH are in the Punk vault basically. And every time you go and buy a Punk, obviously it puts ETH into the pool and takes Punk out, and that puts price up the sort of way that the usual people who are familiar with like buying and selling in any sort of like Uniswap or Sushi pools. There's the idea of slippage and having deeper liquidity. The deeper the liquidity, the more you can buy without prices going up lots. So as things get more expensive, you need more and more and more liquidity in the pool to sort of keep those spreads down. And that's where we're starting to see other tooling and other protocols come into the vein now to sort of try and handle that issue. But we have a lot of bot arbitrage now. So someone will go onto OpenSea or LooksRare or Sudonow, and they'll list at whatever price. A bot will just be scanning an MEV bot, and it'll be like, I can buy that for 0.1 on OpenSea. I can sell it immediately into NFTX for 0.1, whatever, tiny percentage profit points, but just running over and over and over again. So yeah, price is basically kept in line mainly by arbitrage in the market.
Got it. Yeah, you guys definitely paved the path for creating liquid markets in the NFT space. And, when you create a solution to a clear problem, you'll probably find some competition up against you at some point. And kind of related to that, I'd be keen on hearing what the main differences are between NFTX and Sudoswap, which also facilitates liquid trading across floor prices of NFTs.
So yeah, the biggest difference is we deal with fractions of tokens and a single pool. So an NFTX vault is backed by a single pool, which is why it will always trend to floor price, because it's always basically acting as like the lowest common denominator of asset. It's the liquidity pool of the amount of assets that anyone will sell into at what price or buy at that price. Whereas Sudo, it's like a collection of pools. So like when you're browsing on Sudo, it's basically you're just browsing other people's listings. When a sell or a buy happens on Sudo, the person who owns the fees will be the person who was selling the asset, whereas NFTX is socialized pools. So if you are providing liquidity or inventory in NFTX, anytime there's a buy or sell or a swap on it, everyone gets the rewards shared proportionally to their stake. Whereas Sudo, obviously, it could be you could go to buy a punk or something on Sudo and there's 50 punks listed and someone buys one and you may have had your punk listed, either side of it or something, but you don't get any fees because yours didn't sell, basically. So that's why I sort of compare it much more to an on-chain order book and marketplace. And it's got some cool stuff with their pricing curves and LPing ranges and stuff. But yeah, the biggest difference is it's whole units for them, whereas it's fractionalized for us.
Got it. Now, I recently read about an upcoming integration you guys are working on with 0x. It sounded pretty exciting. So could you walk me through kind of the features that'll be introduced with that?
Yeah, so at the moment, all the liquidity in FTX goes into the sushi pools. So anytime you're on the site and you deposit and add liquidity or whatnot, it'll go into the sushi pool because that's where the NFTX rewards come from. Like the rewards that are paid for stakers come out of your proportional balance staking in the sushi pool if you're providing liquidity. But what we want to allow people to do is sort of add, we're called vault tokens, V tokens, like the punk token. So if I say vault token or V token, I'm just referring to punk, the ERC20 token that represents the NFT. We want people to be able to sort of provide liquidity anywhere and the marketplace to source it. So the very common thing at the moment is concentrated liquidity ranges that UniV3 offer, where you can say, I'm happy to LP punk between like 40 ETH and 100 ETH. Like if punk gets down to 40 ETH, I'm happy to be all in punk. If punk gets to 100 ETH, I want to be all out of punk and all into ETH. And those sorts of concentrated ranges obviously allow for much tighter spreads because it's liquidity like condensed into a range, and therefore the more concentrated liquidity you have around the current spot price, the tighter your spreads will be. So it's basically just about giving people the opportunity to add liquidity anywhere and know that it's going to be used for vault activity and activity on NFTX. Things like balance of pools, basically, and it might be that you get in some pool rewards. So if some liquidity provider somewhere is like doing promoting or liquidity mining, rewards, like Sushi used to have onsen rewards back in the day, and NFTX pools used to get like onsen rewards. So it sort of allows that sort of thing. If people want to promote the usage, of NFTX pools on other platforms, they can do that knowing that the NFTX UI marketplace is going to be pulling in that liquidity. So when people buy, sell, and swap from it, they'll be using that liquidity.
Got it. And onto financials. Can you walk us through NFTX's fee model? So who pays fees for what and who earns them?
Yeah, so buyers and sellers and swappers are the ones who pay the fees. And all those fees go to liquidity stakers and inventory stakers. Like the NFTX protocol doesn't take any fees. All the fees, all the rewards earned goes to the people who are providing liquidity and inventory. Probably a good time to define the two different types of stakers in NFTX, right? So there's liquidity stakers. Those are the people who are pairing the punk with ETH in the liquidity pool. And that's the most important role, basically. That's what allows the NFTX protocol to work, with the liquidity providers who are providing the liquidity for people to buy and sell into. Then the other side of it is inventory stakers. And this was actually, I think, one of the coolest probable like breakthroughs or things that has happened in the space when we launched inventory staking late last year. And that allows you effectively, just if you have floor NFTs and you're not personally attached to them, you sort of just want exposure to the project still, you can deposit them into NFTX and you will earn rewards on your vault token. And NFTX rewards are obviously paid in the vault token itself. Fees are paid in punk, for example. So you could just have a floor punk, you'd stake it in NFTX, and you would be earning interest, basically, in punk on your punk. And it's the most popular form of staking by far. Like inventory staking far outweighs liquidity staking because it's aside from smart contract risk, it's risk free. You're just parking it in there. You will always be able to claim the amount of NFTs back that you put in, and you're just earning interest on top of it. So those people, inventory stakers, earn 20% of the rewards. So if it's a 0.1 punk fee to sell instantly, 0.02 whatever goes is spread amongst the inventory stakers, and that 80%, that 0.08, is spread out pro rata against liquidity stakers. And they tend to do really well, liquidity stakers, because there's so much more inventory. You have 80% of the rewards being split out across like maybe only 50% of the entire stakers.
And outside of like general NFT volume and activity dying down, what would you say are like the current drivers or challenges related to your growth?
The main challenge at the moment, I guess, is like retaining interest and stuff through like a bear with NFT volumes, drying out, trying to attract talent, like bringing on more sort of Solidity devs to handle our visions for like V3 and stuff in the future during a trying time of this, where lots of sort of the interest and money or whatever has dried up, or people have left for other projects. So I think just general market sentiment is probably the biggest growth blocker at the moment. But I think a lot of the drivers we've got coming up, we are seeing more and more like protocols spinning up who want to integrate NFTX liquidity into things they do, borrowing protocols, lending protocols, having a immediately liquidatable fungible asset is appealing to a lot of sort of lending and borrowing protocols. And I think we see, and again, that inventory staking seems to like the more people seem to find out about it, the more appealing it gets. So we have a sort of an up only chart really on the amount of inventory stakers, as people sort of realize at the moment, I can just park this in NFTX and earn interest. So those are probably the biggest drivers at the moment.
Yeah, I'm sure attracting talent is definitely a problem a lot of projects are facing right now, and the bear market is not helping out there. And kind of related to the subject, especially technical talent, do you experience a lot of organic community contributions to the code base? Is that something you encourage at all, or are you trying to keep development somewhat in-house?
But on protocol side, like definitely, and sort of on ancillary projects, sort of friend of the NFTX chap called Quantumly is built out and sort of open source subgraph that we've used for things like token holding subgraph that we've used extensively. And that was just sort of like a community contribution. But since like the UIs are closed source, because that's basically what the NFTX DAO pays the product team to build for them, there isn't a lot of community. There's sort of a product team who works on building it. We get a lot of community feedback, so it's full of I like this, I don't like this, can we have this, a lot of requests. But in terms of like pull requests and contributions, no, it's effectively handled in-house.
Got it. Now, a hot topic around NFT liquidity protocols has been related to creator royalties, as they're not paid in trades executed on NFTX and other liquidity protocols. I'd be keen on hearing your thoughts on this topic in general, and whether you have any plans to enforce royalties at some point, or enable voluntary royalty payments on vault contracts, or anything like that.
I guess to start with, from an NFTX point of view, there's nothing in place at the time. NFTX always wants to do everything on chain. I think that's like, so rather than like the social contract of royalties, the only way it can ever sort of be enforced at like the NFTX level would be if it's on chain. Otherwise, people just wrap it. There's always, you end up and they're just being avoided anyway. So we've looked into stuff, and we're sort of monitoring like EIP 2981, I think, which is like basically an NFT royalty standard, like baked into the token. And having stuff like that available, or like on-chain standards, make it much easier than like at the moment just sort of you just read from like, a Web3 database, the royalty percentage, and attempt to tack that on to the transaction basically. We'd like to do stuff where it's basically up to the vault creator. I think that's sort of where our vision for V3 would go, where people like spin up these vaults, they have options on defining sort of royalties, and once those royalties are defined at like a vault level, at a contract level, they become much easier to be, I guess, enforced, so to speak, in that, it doesn't, there's no social contract or, contract relied on it. It's just, that's what the code says, that, to interact with the contract, it requires X royalty, and therefore it happens that way. So in the next sort of version of NFTX, when we hope to have a lot of focus on creator flexibility, sort of maybe launchpad stuff where collections may launch via NFTX and hold a certain percentage of their own supply back or something and be able to define sort of vault royalties. I mean, there will always be a marketplace that spins up somewhere that is royalty free because, you know, free markets, basically, that's always going to happen. So my own personal view is I find royalties to be very high on a liquid floor. So it's quite a tax on people who are buying and selling, I think, when the royalties happen when you have so many of an asset trading at a single price point. It at that point it is really just trading like a sort of derivative, or just I want to buy effectively like shares in that NFT really. And when they're traded like assets at that level rather than sort of, you know, just fewer transactions, higher art and stuff, it's quite an expensive tax, I guess, to pay.
Yeah, that makes sense. I actually really like the plan to enable creator flexibility in the future. That sounds pretty cool. And it's interesting to hear about the technical perspective there, that there's currently a lack of on-chain tools to efficiently support royalty payments. But moving on to the final question, what is next for NFTX? I know you're working on some cool integrations, but what else is on your long-term roadmap? I
think tying a bow on V2 and adding the V2 functionality into, like we've got with the 0x API, in for liquidity. It'll be probably tidying up and spinning up the new marketplace to sort of more match what we're heading with the Yield app, more personalization options or something. So sort of a nicer experience for like browsing using the marketplace. Really trying to make it much easier for users to buy, sell and stake. Like we're hoping soon to get out what we'll just call like a naked ETH zap. So at the moment, when you want to provide liquidity, you know, you either have to have one of the NFTs or you have to have one of the tokens already, and then you pair that with ETH or whatever, and you add liquidity. Whereas I think a lot of people want to come on, they'll browse NFTX yields, they'll see the APRs, and they'll be like, cool, I want some of that. And then they go to stake and they're like, oh, I've got to buy this first, I've got to do that. So we're currently developing just an ETH only zap where you could be like, yo, I just want to put 5 ETH, you know, into this pool, and then you can just be like, oh, I want 1 ETH inventory and I want 4 ETH in liquidity, and it'll sort of do all that magic for you behind the scenes. So basically hoping just to reduce a lot of friction in buying and sells in the short term. And then in the longer term, it'll be like version 3 of the protocol, which again would have a focus on vault creators, as we mentioned, launchpad sort of stuff, really trying to solve, you know, liquidity as best we can. So I think we'd quite like to move to Uniswap V3, where we can sort of tie in concentrated liquidity ranges, so we can have the infinite range backing it, but then also have the concentrated ranges and sort of allow people to then choose their range, you know, where they're happy to be all in ETH or all in NFTs, and sort of set the fees that they want to, set the fee percentage they want to earn.
Awesome. Looking forward to seeing everything play out. Thank you so much, Quag, for taking the time to do this. Really appreciate it.
Thank you for having me.